Welcome to the Global Commerce Academy, your gateway to mastering the world of finance, accounting, and management. We are dedicated to empowering aspiring professionals and students from all backgrounds by providing high-quality, 100% free CMA USA classes. Whether you're just starting your journey in commerce or looking to advance your career, you've come to the right place. At the Global Commerce Academy, we believe that education should be accessible to everyone, everywhere. Our platform is designed to support your learning with comprehensive resources, interactive lessons, and a vibrant community of learners and experts. No matter where you are in the world, you can join our classes and take the next step toward becoming a certified management accountant. Today's lesson is Chapter 8, Budgeting Methodologies Integration, from Section B, Planning, Budgeting, and Forecasting in the CMA USA 2025 Part 1 syllabus. This chapter is a crucial part of your CMA preparation, as it delves into the core concepts and practical applications of budgeting in modern organizations. In this chapter, you'll discover how various budgeting techniques, such as incremental budgeting, zero-based budgeting, and flexible budgeting, come together to form a comprehensive budgeting framework. You'll learn how to integrate these methodologies to create effective, realistic budgets that support strategic decision-making and organizational success. Mastering these concepts is essential knowledge for every aspiring CMA, equipping you with the tools to drive financial performance and add value in any business environment. Let's get started. Budgeting methodologies. Integration means combining multiple budgeting approaches to meet specific business needs. Rather than relying on a single method, companies often use a hybrid model, mixing techniques like incremental, zero-based, flexible, and activity-based budgeting to optimize performance. It ensures more accurate forecasting, efficient resource use, and better strategy alignment. When it comes to managing a company's finances, two of the most common budgeting methods are incremental budgeting and zero-based budgeting. Let's start with incremental budgeting. In this approach, you begin with last year's budget as your foundation. You then make adjustments, typically for factors like inflation, projected growth, or any known changes in operations. This method is popular because it's straightforward and doesn't require a complete overhaul of the budgeting process each year. Teams simply review previous figures, tweak them as needed, and move forward. This saves a significant amount of time and effort, especially for large organizations with many departments. However, the simplicity of incremental budgeting can also be its biggest drawback. By relying on last year's numbers, there's a risk of carrying forward inefficiencies or unnecessary expenses that may no longer be relevant. Over time, these can add up, leading to bloated budgets and missed opportunities for cost savings. On the other hand, zero-based budgeting, often called ZBB, takes a completely different approach. Instead of starting with last year's numbers, every expense must be justified from scratch, hence the name zero-based. Each department must build its budget as if starting from zero, explaining why every dollar is needed. This process increases accountability and forces teams to critically evaluate their spending, making it easier to identify and eliminate wasteful costs. Zero-based budgeting is especially useful in dynamic business environments where costs need to be tightly controlled and priorities can shift quickly. It encourages a culture of cost consciousness and adaptability, which is vital for companies facing rapid market changes or financial uncertainty. In practice, most companies use a combination of both methods. Incremental budgeting is often reserved for stable departments with predictable expenses, while zero-based budgeting is applied to cost-sensitive functions or areas where spending needs to be closely monitored. By understanding the strengths and weaknesses of each approach, organizations can create more effective and efficient budgets that support their strategic goals. A flexible budget adjusts with actual activity levels. For example, if production increases, the budget for raw materials automatically scales up. This approach is used in manufacturing, sales forecasts, and service-based businesses. It's honestly highly useful for performance evaluation in variable environments. So, activity-based budgeting starts by identifying cost drivers for each activity. It's a data-driven approach and, honestly, a lot more precise. For example, you might look at the number of purchase orders, machine hours, or customer support calls. This method really helps certified management accountants reduce waste, improve decision-making, and most importantly, align spending with value. A rolling budget is continuously updated, often on a monthly or quarterly basis. Instead of preparing just one static annual budget, businesses revise forecasts regularly so they can stay aligned with changing conditions. This method increases agility, enables better decision-making, and keeps plans current. In real-world corporate finance, certified management accountants actually mix budgeting methods. For example, they might use zero-based budgeting for marketing, activity-based budgeting for operations, flexible budgeting for production, and rolling budgets for cash flow management. Integration depends on several factors, like the industry, business size, department goals, and risk tolerance. As we wrap up this chapter, let's take a moment to reflect on the key insights we've covered. Integrating various budgeting methodologies isn't just a theoretical exercise. It's a practical strategy that empowers organizations to make smarter, more informed financial plans. By combining different approaches, businesses can adapt to changing environments, anticipate challenges, and seize new opportunities with greater confidence. This integration leads to more robust planning, better resource allocation, and ultimately, improved financial performance. So, what does this integration actually look like in practice? It means leveraging a mix of incremental budgeting for stability, zero-based budgeting for cost control, activity-based budgeting for process efficiency, flexible budgeting for adaptability, and rolling budgeting for continuous improvement. Each methodology brings its own strengths to the table, and when used together, they create a comprehensive framework that addresses both short-term needs and long-term goals. This holistic approach ensures that no aspect of the budgeting process is overlooked. For certified management accountants, mastering these methodologies is essential. It's not just about knowing the theory, it's about applying the right approach to the right area of your organization. Whether you're managing a department, overseeing a project, or guiding an entire company, choosing the appropriate budgeting method can make a significant difference in achieving your objectives. Remember, flexibility and critical thinking are key skills for any CMA aiming to drive value and support strategic decision-making. This concludes Chapter 8, Budgeting Methodologies Integration, a crucial part of the Planning, Budgeting, and Forecasting section in CMA USA Part 1, 2025 edition. We hope this chapter has provided you with valuable insights and practical tools to enhance your budgeting skills. As you continue your CMA journey, remember to revisit these concepts and apply them in real-world scenarios for maximum impact. Thank you for joining us in this session. If you found this video helpful, don't forget to subscribe to the Global Commerce Academy for more in-depth lessons, expert tips, and the latest updates on CMA exam preparation. Stay tuned for our next video where we'll dive even deeper into the world of management accounting. See you in the next chapter.